Hello, students. This is chapter 34, the influence of monetary and fiscal policy on aggregate demand. And we will answer these questions. How does the interest rate effect help explain the slope of the aggregate demand curve? How can the central bank use monetary policy to shift the aggregate demand curve? In what two ways does fiscal policy affect aggregate demand? What are the arguments for and against using policy to try to stabilize the economy? The earlier chapters covered the long run effects of fiscal policy on interest rates, investment, economic growth, long run effects of monetary policy on the price level and inflation rates. This chapter focuses on the short run effects of fiscal policy and monetary policy, which work through aggregate demand. Aggregate demand. Recall the aggregate demand curve slopes downward for three reasons: the wealth effect, the interest rate effect, the exchange rate effect. Next, a supply demand model that helps explain the interest rate effect and how monetary policy affects aggregate demand. The most important of these three effects is the interest rate effect. The theory of liquidity preference. The theory of liquidity preference is a simple theory of the interest rate. Interest rate adjusts to balance supply and demand for money. Nominal interest rate and real interest rate. The assumption expected rate of inflation is constant. So we make an assumption that expected rate of inflation is constant. Money supply is assumed fixed by central bank and does not depend on interest rate. The money demand reflects how much wealth people want to hold in liquid form. Assume household wealth includes only two assets: money, liquid but pays no interest; bonds pay interest but not as liquid. A household's money demand reflects its preference for liquidity. Variables that influence money demand are output, real output, interest rate, and price. Suppose real income, Y, rises. Households want to buy more goods and services, so they need more money. To get this money, they attempt to sell some of their bonds. So, an increase in income or output causes an increase in money demand, other things equal. Active learning 1. The determinants of money demand. Number A, suppose R, interest, rises, but Y, output, and P, price, are unchanged. What happens to money demand? Number B, suppose price rises, but Y and R are unchanged. What happens to money demand? Answers. R is the opportunity cost of holding money. An increase in R reduces money demand. Households attempt to buy bonds to take advantage of the higher interest rate. Hence, an increase in R causes a decrease in money demand, other things equal. B. If Y isn't changed, people will want to buy the same amount of goods and services. But since P is higher, they will need more money to do so. Hence, an increase in P causes an increase in money demand, other things equal. How R is determined? And here is money market. Interest rate is measured on the vertical axis, and quantity of money is measured on the horizontal axis. Money supply is vertical. Changes in interest rate do not affect money supply, which is fixed exogenously by the Fed. Money demand is downward sloping. A fall, um, a fall in interest rate increases money demand. Equilibrium interest rate is where money demand crosses money supply. A fall in price reduces money demand, which lowers interest rate. A fall in price reduces money demand, which lowers interest rate. So money demand shifts to the left, and as you can see, interest rate declines. A fall in interest rate increases investment and quantity of goods and services. So a fall in price reduces demand for money. So demand for money shifts to the left, and that left shift reduces interest rate. And that reduction in interest rate stimulates interest-sensitive expenditures like investment. So a fall in interest rate increases investment spending and quantity of goods and services demanded, as shown in this aggregate demand diagram. Monetary policy and aggregate demand. The Fed, or the Federal Reserve, use monetary policy to shift the aggregate demand curve. Policy instrument. The money supply, MS, targets the interest rate, the federal funds rate. Banks charge each other on short-term loans. The federal funds rate is really an interbank borrowing. Banks borrow from each other. The Fed conducts open market operations to change money supply. Effects of reducing the money supply. The Fed can raise interest by reducing money supply. If you look at the graph to the left side, reducing money supply is shifting this vertical line to the left. The Fed can raise interest by reducing money supply. As you can see, the new equilibrium is at R2. Interest rate has increased. An increase in interest reduces the quantity of goods and services. As you can see, increase in interest will reduce the quantity of goods and services demanded because it will shift aggregate demand to the left. Active learning 2. For each of the events below, determine the short-run effects on output. Determine how the Fed should adjust the money supply and the interest rates to stabilize output. Number A, Congress tries to balance the budget by cutting government spending. Number B, a stock market boom increases household wealth. Number C, war breaks out in the Middle East, causing oil prices to soar. Here's the answer. This event would reduce aggregate demand and output. Aggregate demand will shift to the left. To stabilize output, the Fed should increase money supply and reduce interest rates to increase aggregate demand. Stabilization policy. Number B, this event, a stock market boom, increases household wealth. This event would increase aggregate demand, raising output above its natural rate. To stabilize output, the Fed should reduce money supply and increase interest rates to reduce aggregate demand, and that will stabilize the economy. Number C, when war breaks out in the Middle East, causing oil prices to soar. This event would reduce aggregate supply, causing output to fall. To stabilize output, the Fed should increase money supply and reduce interest rates to increase aggregate demand. Liquidity trap. If interest rates have already fallen to around zero, monetary policy may no longer be effective since nominal interest rate cannot be reduced any further. Aggregate demand, production, and employment may be trapped at low levels. In other words, monetary policy may no longer be effective. A central bank continues to have tools to expand the economy. Uh, Forward guidance raise inflation expectation by committing to keep interest rate low. Quantitative easing would be another tool available to the central bank. Quantitative easing is buy a large variety of financial instruments like mortgages, corporate debt, and long-term government bonds. And that is what the Fed did in the Great Recession of 2008. Fiscal policy and aggregate demand. Fiscal policy is setting the level of government spending and taxation by government policy to achieve economic stability. Expansionary fiscal policy is an increase in government spending and or decrease in taxes, and that will shift aggregate demand to the right. That would be a policy that would be in place when the economy is in recession and needs to be stimulated. Contractionary fiscal policy would be a decrease in government spending and or increase in taxes and would shift aggregate demand to the left. That would be appropriate policy when the economy is above its natural output or is inflationary. Fiscal policy has two effects on aggregate demand. The multiplier effect. Example, if the government buys $20 billion of planes from Boeing, Boeing's revenue increases by $20 billion. This is distributed to Boeing's workers as wages and owners as profits or stock dividends. These people are also consumers and will spend a portion of the extra income. This extra consumption causes further increase in aggregate demand. This demonstration of the multiplier effect. A $20 billion increase in government spending initially shifts aggregate demand to the right by that $20 billion. This is $20 billion shifting aggregate demand to the right. The increase in output causes consumption to rise, which shifts aggregate demand further to the right. That is the multiplier effect. So, multiplier effect, the additional shift in aggregate demand that results when fiscal policy increases income and thereby increases consumer spending. Marginal propensity to consume. How big is the multiplier effect? It depends on how much consumers respond to increase in income. And that's what marginal propensity to consume is. MPC is delta C divided by delta Y. And that's the fraction of extra income that households consume rather than save. For example, if MPC is zero point 0.8 and income rises $100, then consumption will rise $80. A formula for the multiplier can be derived. Notation: delta G is the change in government. Delta Y and delta C are the ultimate change in income and consumption. The identity Y equals C plus I plus G plus net X. Delta Y is equal to delta C plus delta G. Investment and net exports do not change in this regard. Delta Y is equal to MPC times delta Y plus delta G, because delta C is MPC times delta Y. When we solve for delta Y, we get 1 over 1 minus MPC times delta G. And that 1 over 1 minus MPC is the multiplier. The size of the multiplier depends on the MPC. If, for example, MPC is 0.5, the multiplier is 2. You simply use this formula. If the multiplier is 0.75, the multiplier is 4. If MPC is 0.9, the multiplier is 10. A bigger MPC means changes in Y causes bigger change in consumption, which in turn causes bigger change in output. MPC varies directly with the multiplier. Other applications of the multiplier effect. The multiplier effect. Each dollar change in government spending can generate more than a dollar increase in aggregate demand. Also true for the other components of GDP. For example, suppose a recession overseas reduces demand for US net exports by $10 billion. Initially, aggregate demand falls by $10 billion because net export is part of aggregate demand. The fall in output or income causes consumption to fall, which further reduces aggregate demand and income. The crowding out effect. The crowding out effect offset in aggregate demand. It results when expansionary fiscal policy rises or raises the interest rate, thereby reduces investment spending, which reduces the net increase in aggregate demand. So the size of the aggregate demand shift may be smaller than the initial fiscal expansion. How the crowding out effect works. Money market, the economy is at equilibrium at R1, and a $20 billion increase in government spending shifts aggregate demand from AD1 to AD2 by that $20 billion. But higher output or higher income increases money demand, shifting money demand to the right and raising interest rate. Interest rate rises, and the rise in interest rate will reduce aggregate demand. And so that rise in interest rate neutralizes that initial expansion, and that is what crowding out is. Changes in taxes. A tax cut increases household take-home pay. Households respond by spending a portion of this extra income, shifting aggregate demand to the right. The size of the shift is affected by the multiplier and crowding out effect. Another factor, household perception. Permanent tax cut would lead to large impact on aggregate demand. Temporary tax cut would be a small impact, as consumers will expect that they will have to pay that tax anyway, so they will cut down on their consumption spending. Active learning number 3, fiscal policy effect. The economy is in recession. Shifting the aggregate demand curve rightward by $200 billion would end the recession. Number A, if MPC is equal to zero point 0.8 and there is no crowding out, how much should Congress increase government spending to end the recession? Number B, if there is crowding out, will Congress need to increase government more or less than this amount? Number A, if MPC is zero point 0.8 and there is no crowding out, how much should Congress increase government spending to end the recession? The multiplier is 5 using that formula. Increase government spending by 40 to shift aggregate demand by 240 times the multiplier. Number B, if there is crowding out, will Congress need to increase government more or less than this amount? Crowding out reduces the impact of government spending on aggregate demand. To offset this, Congress should increase government spending by a larger amount to compensate for that reduction. Case study, fiscal policy, and aggregate supply. Fiscal policy might affect aggregate supply. People respond to incentives. A cut in tax rate gives workers incentive to work more, so it might increase the quantity of goods and services supplied and shifts aggregate supply to the right. People who believe this effect is large are called supply siders. Government might affect aggregate supply. Example, government increases spending on roads. Better roads may increase business productivity, which increases the quantity of goods and services supplied and shifts aggregate supply to the right. This effect is probably more relevant in the long run. It takes time to build new roads and put them into use. A case for active stabilization policy. John Maynard Keynes spoke of the animal spirits. Animal spirit caused waves of pessimism and optimism among households and farms, leading to shifts in aggregate demand and fluctuations in output and employment. Also, other factors that would cause these fluctuations are booms and recessions abroad, stock market booms and crashes. If policymakers do nothing, these fluctuations are destabilizing to businesses, workers, and consumers. So Keynes was making a case for active stabilization policy. Proponents of active stabilization policy. Government should use policy to reduce these fluctuations. When GDP falls below its natural rate, use expansionary monetary or fiscal policy to prevent or reduce a recession. When GDP rises above its natural rate, use contractionary policy to prevent or reduce an inflationary boom. Keynesians in the White House. Case study. In 1961, John F. Kennedy pushed for a tax cut to stimulate aggregate demand. Several of his economic advisors were followers of Keynes. In 2009, President Barack Obama uh, took, took over the government when the economy was in recession. And that was the Great Recession. The policy was, his first major policy was a stimulus bill, the American Recovery and Reinvestment Act, ARA. Substantial increase in government spending, almost $800 billion, was in place. That is a Keynesian move to stabilize the economy. This is what the experts say about economic stimulus. Because of American Recovery and Reinvestment Act of 2009, the US unemployment rate was lower at the end of 2010 than it would have been without the stimulus bill, and 97% agreed. Zero uncertain and 3% disagreed. So they're saying that that stimulus did a good to neutralize the severe effect of the recession. Another uh, opinion of the experts, economic stimulus, taking into account all of the RR's economic consequences, including the economic costs, raising taxes to pay for the spending, its effects on future spending, and any other likely future effects. The benefits of the stimulus will end up exceeding its cost. And yes, 75% agree. 19% uncertain, 6% disagree. The case against stabilization. Monetary policy affects economy with long lags, and these lags would neutralize the effect of policy. Firms make investment plans in advance, so investment takes time to respond to changes in interest rate. Most economists believe it takes at least 6 months for monetary policy to affect output and employment. Fiscal policy also works with the long lag. Changes in government and taxes require acts of Congress. Legislative process can take months or years. Due to these long lags, critics of active policy argue that such policies may destabilize the economy rather than help it. By the time the policies affect aggregate demand, the economy's condition may have changed. They contend that policymakers should focus on long run goals like economic growth and low inflation. Automatic stabilizers. Automatic stabilizers are changes in fiscal policy that stimulate aggregate demand when economy goes into recession without policymakers having to take any deliberate action. Automatic stabilizers examples: tax system. In recession, taxes fall automatically, which stimulate aggregate demand. Government spending. In recession, more people apply for public assistance, welfare, and employment insurance. Government spending on these programs automatically rise, which stimulates aggregate demand. In conclusion, when Congress cuts taxes, it should consider the short run effect on aggregate demand and employment and the long run effect on savings and growth. When the Fed reduces the rate of money growth, it must take into account not only the long run effects on inflation, but the short run effects on output and employment. Summary. The theory of liquidity preference. The interest rate adjusts to balance the demand for money with the supply of money. The interest rate effect helps explain why the aggregate demand curve slopes downward. An increase in the price level raises money demand, which raises the interest rate, which reduces investment, which reduces the aggregate quantity of goods and services demanded. In an increase in the money supply causes the interest rate to fall, which stimulates investment and shifts the aggregate demand curve to the right. Expansionary fiscal policy, a spending increase or tax cut, shifts aggregate demand to the right. Contractionary fiscal policy shifts aggregate demand to the left. When the government alters spending or taxes, the resulting shift in aggregate demand can be larger or smaller than the fiscal change. The multiplier effect tends to amplify the effects of fiscal policy or aggregate demand. The crowding out effect tends to dampen the effects of fiscal policy on aggregate demand. Economists disagree about how actively policymakers should try to stabilize the economy. Some argue that the government should use fiscal and monetary policy to combat destabilizing fluctuations in output and employment. Others argue that policy will end up destabilizing the economy because policies work with long lags. That ends this lecture on chapter 34.